Hey everyone, welcome back to Finance Sphere. Right now, as crypto prices take a heavy beating, YouTube is flooded with the exact same questions. Is this the absolute bottom, or are we going down further? But here is the real truth. If you are still watching crypto analysis and tracking this market right now, you are an absolute OG. The general public, they've completely checked out. The retail crowd has packed up and moved on. Their attention has shifted entirely to AI and semiconductor stocks. The only ones left in this forgotten market are seasoned veterans, or the diamond hands who bought the very top of the last cycle and refused to give up. The weak hands have been completely shaken out. Anyone who was going to panic sell from the crash or get exhausted by this prolonged bear market is already gone. And the few OGs left are all obsessing over one thing: when can we catch the exact bottom? Today, we're taking a completely different angle. I'm not here to debate whether Bitcoin hit the exact bottom today or not. What I am telling you is this: after a drop of this magnitude, it is time to stop bottom sniping and start preparing for the next wave. Look, everyone dreams of buying the exact low, but timing the market bottom in real time, it's nearly impossible. As an individual investor, you don't need to catch the exact bottom tick. Buying in a deeply undervalued zone and scaling out into pure market euphoria is already a major win. So today, we're shifting our focus away from bottom hunting. We're laying out a concrete step by step game plan to position ourselves for the next bull market. To set the stage, we have to answer two critical questions. What does the macro environment actually look like right now? And is Bitcoin truly undervalued? To understand macro, you have to look at the broader economic cycle. The economy moves in predictable, regime based swings between expansion and contraction. It all comes down to supply and demand. Traditionally, Wall Street splits this economic cycle into four distinct regimes: Goldilocks, strong growth with contained inflation, an ideal environment for risk assets; overheating, high growth paired with high inflation; stagflation, low growth coupled with high sticky inflation; reflation or recession, low growth and low inflation. When institutional analysts break down the market, their very first question is always, which regime are we sitting in right now? They argue we are transitioning from late stage Goldilocks straight into overheating. In this regime, corporate earnings stay surprisingly strong, while lower interest rates give growth stocks a substantial tailwind. Proponents point out that despite elevated inflation, the labor market and consumer spending remain resilient, while AI productivity gains are driving structural efficiency. Furthermore, global central banks and fiscal authorities haven't fully tightened liquidity, opting for rate cuts and balance sheet maneuvers to hedge downside risks, keeping risk on sentiment alive. Under this thesis, as we shift into overheating, commodity prices get bid up, triggering a broad capital rotation into hard assets, energy, and crypto. Here in 2026, the US and major global governments are running huge budget deficits, pouring hundreds of billions into infrastructure, supply chain reshoring, AI, and national security. Even if private consumption softens, this aggressive government spending creates meaningful downside support for the economy. Bulls view Fed rate cuts as proactive insurance cuts, with central banks ready to unleash emergency liquidity facilities the moment systemic stress appears. In an overheating environment, the top performing assets are commodities, energy, hard assets. Think about the mechanics. When energy prices surge, electricity costs rise, which directly pumps up the production cost for Bitcoin mining. Look at the industrial sector. The copper to gold ratio gives us a valuable read on this transition. Copper represents real world industrial expansion, while gold represents panic, systemic risk, and flight to safety. A rising copper to gold ratio signals that institutional capital is rotating hard into risk on mode. Historically, whenever the copper to gold ratio bottoms out and rips upward, Bitcoin price action follows shortly after. In our last video, we broke down on chain data and noted that while Bitcoin is fundamentally undervalued, downside risk wasn't fully ruled out due to muted spot market demand. That spot demand remains quiet today. However, looking at higher timeframes, market cycle bottoms continue to form higher lows. Whether we've called the cycle low or not, current price levels represent a highly attractive value zone. Trying to be cute and wait for the exact market low is the easiest way to miss the entire bull run. Here is our 3-step blueprint for the upcoming bull market. Step 1. Scale and via dollar cost averaging. Accumulate on dips and buy into oversold territory to bring your average cost basis down. Going all in at once just because the bull market is coming is an easy way to get punished by volatility. The early stages of a bull market are notorious for aggressive swings and sharp shakeouts. Set up routine buys or scale in at key structural support levels. Step 2. Identify the next market leading narratives. Crypto is a high beta risk asset, meaning performance varies wildly depending on which sector catches the narrative tailwind. In 2020 to 2021, the bull run was fueled by zero interest rate policy and global QE liquidity. Over the last few years, it was driven by the Bitcoin and Ethereum ETF narratives. But while ETFs acted as a one-way on-ramp, bringing traditional capital into crypto, the defining theme of this upcoming cycle is the convergence of real-world asset, tokenization, and institutional financial infrastructure. This connects crypto and traditional capital markets into a two-way, fully integrated capital engine. Step 3. Establish a strict take-profit plan before the euphoria hits. This is the single most critical part of your strategy. When the mania kicks into full gear, people get drunk on euphoria, convince themselves prices will go up forever, and lose all objectivity. Greed blinds investors from locking in gains. You must set a disciplined, tiered exit strategy in advance. Here is a 3-phase exit strategy. Phase 1. When macro targets hit or on-chain metrics show extreme overheating, cash out 20 to 30% of your portfolio. Phase 2. When major macro catalysts play out, like months after a midterm election or global liquidity peaks, cash out another 40 to 50%. Phase 3. Sell the remaining position when key technical market structure support levels break on higher time frames. At the peak of a bull market, fear completely vanishes. People who never cared about investing will suddenly start asking you for altcoin picks, and mainstream media will be blanketed with Bitcoin new all-time high headlines. Bad news will be completely waved away with claims that macro doesn't matter anymore. Don't let market euphoria trap you into missing your exit. Investors who trade on pure emotion and hype always end up becoming exit liquidity for smart money. Only those with clear systems, strict risk management, and a calculated plan will walk away as winners. If you found this breakdown valuable, hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Thanks for watching, and I'll see you in the next one.